Mike Martin's here, Mike Martin's channel. Thanks for joining me, guys. Mortgages understated by 40%. Dutch. What's going on, people? Analysts in the Deutsche Bank have identified a major flaw in the prudential's regulatory mortgage data, which they believe severely understates the average balance size of an Australian mortgage because it fails to adjust for split loans. Okay? I covered this a long time ago. Here it is. Long time ago in a video, right there. And I was off by many years. This video was in 2015, so this was an old video. But let's continue. This, they argue, may have resulted in the $276,000 figure that the average mortgage balance being understated up to 40%, potentially giving regulators, economists, and the broader analyst community a false sense of comfort about the indebtedness of the Australian household. Sorry, I'm getting a massive amount of messages here. In a note sent to clients this week, Matthew Wilson and Anthony Hu said the number of residential loans to household reported the Australian Prudential Regulation Authority makes no sense. The APRA appears to have a data problem. The number of mortgages is up 75% since March 2008, yet the population's only 18% over the same period, the analysis said. So remember when I kept saying, no. Well, it goes back to this. Let me play this. I play it all the time. Why? There's a couple of people who don't like me playing this. But I gotta play it because why? And this goes right here. Oversupply, coming 2016, supply and demand illusion. The supply and demand illusion has been on my radar since I've been doing mortgage, this housing crisis covering all the English-speaking countries. We suspect that data cannot cope with the loan splitting, and hence the average balance data presented is of little use. So this ACFG of Australia, this is for the 1 day here, related quotes. So let's continue here. The analysts are suggesting that because many customers have split the same mortgage into multiple formats, the average balance reported, the aggregate numbers underestimates the true average of a home loan size per household. For instance, if a customer has a split $1 million mortgage 50-50 into fixed rate and variable rate loans, it implies that the average loan balance of $500 large, not $1 million. The analyst estimates that the average reported mortgage balance of $276 large is underestimated by 40%, is based on assumption by 50% of all mortgages that are not all split, while the remaining balances are split 3 ways. So here it is. In Canada, we don't have this. We just have a mortgage. We have a second mortgage and a third mortgage and maybe a fourth mortgage. But we don't have where you could split the mortgage like they do in Australia. I don't think we can. I don't know. I haven't been in the banking industry in years. Questionable statistics. The Reserve Bank, which also maintains mortgage data set based on scrutinizations, has also determined the average mortgage balance for about $300 large, which may also be understated if split loans are not accounted for. The further evidence that official statistics is incorrect is buried in a footnote of ANZ Banking Group full last year results presentation on a page entitled Australian Home Loans Portfolio Overview. ANZ discloses that calculating new accounts, the figure includes increase to existing accounts and split loans, fixed variable components on the same loan. The APRA data is also significantly different to figures presented by ASX listed to mortgage aggregator AFG, which reports that the average home loan balance is $509,736 based on over $27,000 mortgages lodged in the first quarter of 2019. Several sources have confirmed that the APRA data did not account for split mortgages and therefore may be understating the average mortgage balance. Books, bad upkeep on the books, and no one knows what's happening. But the data also overstated the average because it fails to account for the offset accounts, in which households may hold excess cash against their mortgage to reduce their interest payments. These loans account for 8 to 10% of the balance of the bank's total mortgage books. The Reserve Bank has previously presented household indebtedness in charts, we already went over this many times, that adjust to offset accounts, but these appear to have a marginal impact on overall debt to income ratios and repayment to income ratios. That's very important, total debt service ratio. And the repayment, the money is already called for, so disposable income is at the lowest levels historically it could be. While the average mortgage balance figure may imply households are carrying less debt than they actually are, the prudential regulator relies on the metrics of serviceability and loan to volatilization ratios understand the borrower's indebtedness. So basically, looking at what the risk factors are, how much risk is there involved, and if people's debt service ratio aren't properly being accounted for or being called out or set up properly, then you're going to skew the numbers, and then analysts around the world start reading the numbers they think they have, and they're like misrepresenting everything that's happening. I knew this was a disaster many years ago, guys. So I'm not post-dicting things. I'm telling you what you guys are in store for here. The Deutsche Bank report is not the first time that the accuracy mortgage data, which has become critical for regulators that are trying to assess the financial stability impacts of the housing market and potential impact on household wealth consumption, and has been called into question. With the APRA imposed restrictions on investor loans, led to differential home loan pricing. $50 billion in mortgage were subsequently reclassified. The owner-occupied loans are as customers sought to borrow to lower rates. So there's lots going on down under, guys. I'm really scared for the Australians down there, especially the ones that were told that everything's fine, economy's doing fine, jobs are fine. We're going to start to see the cracks, we're going to start to see the fractures, and we're going to start to see the pain. I hope God is with everyone on this one, because this is buying a house, like I've been saying for years, is one of the most important financial decisions you'll ever make in your life, and you got to make sure you make the right decision, and you buy what you could afford to pay back. And anything over $300,000, $400,000 is way overpriced. Once they have to put, what's keeping all this crap together? Lower interest rates, and they're going to lower rates even more. They need to lower rates. They need quantitative easing to steal your future away. And while major cities are mass exiting to smaller towns and smaller suburbs, who's going to flip the bill? That's my concern. Who's going to flip the bill for these big cities, for their expenditures? Hospitals, doctors, policemen, garbage men. Who's going to flip that bill? That's what I'd like to know. Anyways, let me know what you guys think in the comments below. Let me know. Thank you for watching.